is simple, actionable, also directly relevant to your business. So feel free to take notes, ask questions at the end, and think about anything that could apply to your export operations. The Q&A or chat box is available for you to use. And like I said earlier, after this whole webinar, we're going to be tackling all the questions that you have sent or submitted on the Q&A box. Okay. Now, it is my pleasure to introduce tonight's speaker, Cliff Entricken. He is the CEO of Convergence Capital Group. Cliff has been a seasoned expert with over 20 years of experience in leading supply chain finance programs across Asia. With a deep understanding of both banking institutions and capital markets, he has worked extensively with global development institutions such as IFC and ADB and has advised more than 100 banks and finance companies on implementing scalable real-world trade finance solutions. His company, Convergence Capital, specializing in helping exporters in emerging markets, just like many of you here in Indonesia, access international financing through receivables purchase programs that are non-debt and cash flow friendly. Cliff also brings a strong track record in working with both global service providers and regional regulators. And today, he'll be sharing insights into how Indonesian exporters can leverage cross-border trade finance to grow sustainably even without any traditional bank loans. Please join me. Welcome, Cliff Entricken. Cliff?
Hi, thanks, John. Especially thanks to you, Ronnie, and the IEC team. It's definitely a pleasure to have the opportunity to speak to your members and discuss the opportunities and benefits that lie with them in supply chain finance. Before we get into everything, let me start by introducing who we are and why we're here. Convergence Capital is a fintech company headquartered in Singapore, but we have operations across Hong Kong, the Philippines, Indonesia, Thailand, and Malaysia. So our core focus is Southeast Asia. We were built with a clear mission to help exporters in Asia get paid faster, access better financing, grow sustainably, especially when traditional options from banks fall short. Our clients are mostly exporters across Southeast Asia, India, and Hong Kong. They're selling primarily to developed markets like the US, Europe, Japan, but ultimately what they all have in common is that they face long payment terms, they have limited working capital, and all of this slows their ability to fulfill new orders and scale. So ultimately, that's where we come in. So we specialize in supply chain finance, specifically receivables and payables finance, working with a network of global capital markets players like hedge funds and finance companies to get cash into the hands of exporters before the buyer pays. But we're more than just a finance provider. We partner across the entire trade ecosystem, from buyers and insurers to customs brokers and logistics providers, ultimately to build these customized, low-risk financing solutions that unlock cash flow. They protect against buyer default, something that many banking solutions cannot do in certain markets, and ultimately support long-term business growth without the collateral such as land or other similar immovable assets that banks normally rely on. At the end of the day, though, our goal is simple: make trade finance faster, smarter, above all, more inclusive for the exporters that power Asia's economy. Just to give you an overview of where our operations lie, we operate in a lean but really strategic footprint across Asia, focused entirely on supporting cross-border trade finance. Our headquarters and client relationships teams are based in Singapore and Hong Kong, which also give us direct access to capital markets, regulators, and funders across the region. We've got operational support in Malaysia. So that team is all backed by former Citibank executives that handle back office processes like transaction checking, invoice validation, and overall servicing that goes on to bridge the gap between our exporter clients and our funding providers. On the technology side, our technology is actually all built in Indonesia itself. So we do have our development office there, and we rely on our team there to keep our platform going strong. And then we have representative offices across Asia and even beyond. So some key markets in that regard include Vietnam, Bangladesh, etc. But above all, this regional model allows us to combine on-the-ground insight with international liquidity that we pull from markets, like we said, Hong Kong, Singapore, UK, US, ultimately helping exporters in emerging markets access affording working capital from global investors. And then although our mission is global, our focus is very much centered on Asia. So that's where we see the greatest need and opportunity for trade finance innovation. John, I think you can go to the next slide.
Yes, for a while. Let me just try to reshare, okay?
There we go. Can you see the global footprint slide? All right. Our team is actively working across what you see here, Southeast Asia, South Asia, Greater China, really supporting exporters who sell into developed markets, like we said, US, Europe, Japan, etc. These are typically open account transactions where payment terms can stretch as far as 60 to 120 days after shipment, which, as you know, creates cash flow gaps for you exporters. So by leveraging our global network of funders, mainly from US, UK, and other developed markets, we're able to provide financing that bridges those gaps, even when local banks can't. So what makes our model unique is the combination of deep regional knowledge and access to institutional liquidity from overseas. So we serve ultimately as this bridge, like I said, between exporters primarily in Asia and these liquidity providers, hedge funds, et cetera, based out of developed markets. So now let's zoom in on the current state of supply chain finance here in Indonesia. Indonesia has a strong foundation. It's the largest economy in Southeast Asia with a growing base of exporters across textiles, agricultural, seafood, furniture, and more. But despite this export strength, which continues to grow, most businesses, especially MSMEs, still struggle to access the working capital they need. Traditional bank loans are very hard to get, and many exporters have to rely on internal cash or informal financing where rates can be extremely, extremely high. So even though Indonesia has a very good legal framework to support things like receivables finance, adoption remains low. This is mainly due to lack of awareness, limited acceptance of what we call movable assets, and relatively low engagement from international funders, especially when compared to markets like Vietnam or Thailand. So what do we mean by movable assets? It's like I mentioned earlier, banks in emerging markets tend to rely on immovable assets as collateral. So that is land, that is large capital equipment, in essence, things that are immovable. Movable assets tends to be things like invoices, inventory, intellectual property, things of that nature. Sorry, Rian, unfortunately, I cannot speak Indonesian Bahasa. Sorry, I think one thing we can do, we can provide this presentation after the fact in Bahasa as well. And if you have specific questions in Bahasa, Ronnie can help translate as well. So sorry. So things are changing in Indonesia. So digital adoption is rising. Exporters are becoming more sophisticated. The global shift away from China that's currently happening as well means more international buyers are looking to source from places like Vietnam and Indonesia. So we see this as a moment, as a real inflection point where the right financing tools, if made simple and accessible, can help Indonesian exporters unlock new growth. So to build on the previous slide, this is the broader context for supply chain in Indonesia, supply chain finance in Indonesia. Right now, SCF is still in the early stages of adoptions, but the potential is huge. Indonesia has all the right ingredients. There is a very large, diverse export base. There is a very strong manufacturing and MSME sectors, and there's growing international demand, like I said, especially as international buyers start moving and diversifying away from China. But there are clear challenges. So most working capital needs are still being met through this internal cash or traditional bank loans, which are either expensive, they're slow, or downright inaccessible, especially for smaller exporters. Now, supply chain finance solution like factoring and receivables finance, they exist, but they really only serve a very small fraction of exporters. A lack of mature infrastructure, above all, I think market awareness and funder participation is holding back this wider adoption. But there are encouraging signs, and there's strong regulatory momentum towards this idea of financial inclusion. So that's the gap we're ultimately focused on closing by making supply chain finance simpler, making it digital, being the on-the-ground servicers for overseas funders based in UK, US, etc. We can help unlock Indonesia's full export potential, especially for MSMEs that are often left out of traditional finance. So now let's take a closer look at the export landscape. In 2024, Indonesian exports reached almost 265 billion US dollars. So that was a modest increase of 2.3% over the previous year, but the bulk of this growth came from manufacturing and agriculture, which is perfect for supply chain finance. Manufacturing exports rose over 5%, which continue to dominate most of the outbound trade. But what's more exciting is there was nearly 30% growth in agriculture, forestry, and fisheries, which, I mean, that gives a clear sign that there's a new export category that's really gaining traction in the market. Other key sectors driving this important performance include textiles and garments, footwear and leather goods, palm oil, coffee, spices, seafood, furniture, handicrafts. I mean, you guys are probably from all of these different industries, so I'm sure you know. Geographically, Indonesia's top export destinations remain China, US, Japan, ASEAN countries, EU, etc., which means many exporters are selling to developed market on these open account terms, and you're being forced to delay payment of 60 to 90 days after shipment. So we have this growing diversified export base, but one that's still very vulnerable to cash flow constraints, especially when new buyers are demanding longer terms or order volumes increase. And you have to realize when we talk about this shift that could be coming from buyers diversifying from China, if they've been working with Chinese manufacturers, they're used to getting 60 90-day payment terms because of the capital markets that are available to exporters in China. The whole government and market in China is geared around export growth. So they have all of the bank and financial institutions to support that. And like I said, Indonesia is getting there, but it's going to take some time. In the interim, you do have outside players like us who can help mend the gap. All right. Indonesia's macroeconomic picture is also generally positive. GDP grew by over 5% in 2024, and this was based a lot due to domestic demand and recovery in services. Inflation was also moderate at just above 3%, helped by lower food and energy prices. So despite a healthy macro environment, small firms still struggle the most with access to finance, 32% citing it as a top barrier. Even medium and large firms are reporting financing as a constraint. So in general, on top of that, 56% of firms face competition from informal businesses, and many are still unregistered at startup, limiting even access to financial products. So, I mean, what this tells us is economic growth is actually outpacing the efforts of financial inclusion, especially in the SME and export segments. So while Indonesia is growing, many of the businesses powering that growth still don't have the tools or access to capital to fully participate. So that's why we've targeted supply chain finance solutions built for the realities of this market and why they are so critical. So in this next slide, I'll dive deeper into the financing behaviors of these firms and why these traditional financing models really fall short. So this slide gets to the core of the challenge we're here to address: how difficult it is for Indonesian firms, especially SMEs, to access the financing they need. So first off, starting with the constraints. For small firms, access to finance is the number one challenge, affecting nearly a third of all businesses. For medium-sized firms, it's still the top issue, followed by political instability and crime. Even large firms report access to finance as a notable concern, 15%. So now looking at the numbers, nearly 80% of firms have a bank account, but only less than 30% of them use banks to actually finance investments. And then small firms have just 23% using bank financing, and over 82% have to rely on internal funds. So this confirms what we're seeing on the ground. Businesses are exporting, but they're doing it without the financial support they need to scale, especially when buyers are pushing long payment terms. So this is why receivables finance and supply chain finance are so important. They let exporters unlock cash from their invoices, and we do this without taking on debt or you giving up equity. And we'll show how that works in the next few slides. And then where the Indonesia legal and regulatory framework, how they actually support this, are in process of even supporting domestic capabilities in this manner as well. So, like I mentioned, let's talk about the Indonesia's legal strengths that honestly remain underutilized. So they have the ability to finance these movable assets. Like I mentioned, accounts receivable, invoices, purchase orders, inventory all fall into this movable asset bucket. So under Law 42 of 1999, Indonesian MSEs are legally allowed to use movable assets like receivables, inventory, and equipment as collateral for loans without having to give up physical control of those assets. So this is especially important for businesses that don't own land or buildings and might not qualify for fixed asset backed loans. Um, so there's also been a digital fiduciary registration system created under the Ministry of Law and Human Rights. So this allows the movable assets to actually be pledged on this tool as well. So in theory, these are powerful enablers of supply chain finance. And we've seen this also happen in Vietnam. We've seen it in Philippines. You do need these as foundations, um, but it's been hesitant to actually catch on. And why is that? So number one, the registration process is still very difficult. Number two, a lot of local funders just haven't caught on. They aren't comfortable with accepting non-land, non-building type collateral unless there's the insurance of a buyer rating on this. And then out-of-court enforcement is legally unclear. So there hasn't been a lot of court cases to back up the experience of financing movable assets. There is hope, though. There is a new bill being drafted, a new movable asset security bill to more or less modernize and consolidate the legal framework. So this bill would expand the scope to include things like IP and future income. It would simplify procedures to register candidates and establish a centralized registry, which would boost funder confidence. But as of now, as of this discussion, it's not yet into law. But what does that mean for supply chain finance? It means the legal foundations are in place, but until registration becomes easier and enforcement, private platforms like ours need to step in and provide structures with overseas funding. But the growth will really take off once domestic lending capabilities are able to support these types of structures as well. I won't go into this too much because this is very legal driven, but there are reforms underway to really help some of these fintech driven solutions on the domestic front. So we've got law number 77 in 2016, number 10 in 2020, which these are focused on peer-to-peer lending and multi-funder lending models. So this is from a domestic standpoint. So this is exactly the type of structure we do. But like I said, these laws are in place, but there's not a large uptick in growth from a domestic standpoint to fulfill all the needs. The digital economic policy, so this is really setting the national direction for digital transformation. So it's going to encourage banks and fintechs specifically to collaborate on SME financing. And supply chain finance will be a major portion of that. And then e-factor integration and e-KYC guidelines. So all of these create the foundational guidelines and support systems to make all of these processes easier. But of course, the challenges remain. There is no harmonized rule book around invoice assignability, credit insurance, or what makes an invoice eligible across different platforms. Bank adoption of supply chain finance is still inconsistent. So all of this brings opportunity for private platforms like Convergence to bring in overseas liquidity and help exporters. So now I want to shift gears to items that are pretty much directly affecting all of you. So up until now, we were focused kind of on the domestic side. Where is the economic factors? What are the legal and regulatory frameworks that are taking place? But now let's focus on the external trade environment. So especially when it's changing as dramatically as we've seen in recent years. So we've got the ongoing US-China trade war, which has had a massive impact on global supply chains. Steep tariffs on Chinese exports, especially in garments and agriculture, have prompted US buyers to rethink their sourcing strategy. So this is where some of the opportunities for Indonesia comes in. So as part of US's China Plus One strategy, importers are actively seeking new supply bases in emerging markets. And with lower tariffs, strong production capabilities, an increasingly stable macro environment, Indonesia is well positioned to step in. So let's look at it by some key sectors or industries. So number one, garment exporters. U.S. apparel brands are massively cutting their exposure to China. This opens the door for Indonesian manufacturers, but only if they can meet the demand for speed, compliance, and financial flexibility. So, like what they've always had dealing with Chinese exporters, they're going to want their 60, 90, 120-day payment terms, and you've got to be able to support that to remain competitive. Agricultural exporters. So there's going to be, and there is rising demand for coffee, cocoa, spices, palm-based products, especially with quality and traceability, which will be key to accessing premium buyers. Of course, to be able to support this, SMEs and MSMEs will still face challenge. Limited scale, working capital, export readiness, the need for stronger digital tools, the need for trade partners like IEC. All of this is key. So the takeaway is simple. So U.S. tariffs on China really equal a market opening for Indonesia. But the MSMEs, SMEs need to move fast with support. You're going to have to be able to remain competitive in order to win these global buyers. And this is where supply chain finance can really help you retain that competitiveness. So to make all of this a little more concrete, let's walk through a real world example. So focusing on one of Indonesia's most globally competitive industries, garment manufacturing. The garment sector is one of the biggest export contributors in Indonesia and a key beneficiary of this global shift from China, like I mentioned. Despite this opportunity, it's one of the most difficult industries and which will be affected by long cash conversion cycles. So in this next slide, we'll look at a case study of a typical financial journey of an Indonesian garment exporter. When they purchase raw materials, how long it takes to manufacture and ship goods, and how delayed buyer payments affect working capital. This example helps illustrate where supply chain finance can be applied, how it improves cash flow, and what kind of impact it can make on a manufacturer's ability to grow and ultimately fulfill large international orders. So let's see how this plays out. So let's walk through the real numbers behind the pain points we just discussed, using a typical Indonesian garment manufacturer in Bandung as an example. So many factories operate on open account terms where they get paid by overseas buyers 60 to 90 days after shipment. But to fulfill those orders, they often have to pay for raw materials even further up, 60, 90 days in advance, sometimes even earlier if the fabric is imported. Now, if you look at the full cycle as an example, so day minus 90 from date of shipment, raw materials are paid for. At day negative 60 to minus 30, the goods are manufactured and being trucked to the port of FOB. And then once they are shipped and the buyer takes owners, 60 days later, the buyer finally pays. So that means cash is locked up for as long as 130 to 160 days. So during that time, the factory still has to pay wages, pay utilities, and other costs, not just the raw materials. And that relies on, that means relying on expensive overdrafts, supplier loans, or delaying other purchases. The working capital gap directly affects their abilities to take on larger orders, extend competitive credit terms to buyers, or invest in process improvements and certifications. So as we saw earlier, this is a major drag on competitiveness, especially when global buyers are demanding faster turnaround and higher compliance. The regional example at the bottom is also a good illustration. The mid-sized factory in Bandung ships to a U.S. buyer on 90-day terms, but must pay for fabric up to 90 days before production starts. In that scenario that we came across, that's a 180-day swing in that case. So it's tying up valuable cash flow that ultimately could be used to grow the business. And that process becomes more difficult with the complexity of product you're developing. So in the case of garment manufacturers, if it's a simple white t-shirt, it may be a 30-day turnaround, and the raw materials are not as expensive. But if you're exporting complex outerwear like ski jackets or high-tech raincoats, then not only is your manufacturing lead time of 30 days now moved to 60 or 90 days because of the complexity, but your raw materials are much more costlier as well. So now that we've seen the financing gap, we know these issues exist in Indonesia, which I know all of you know this already. That's why you're here. Let's talk about how supply chain finance can help close that gap. So supply chain finance isn't just a product, it's a way to unlock liquidity that's already embedded in the supply chain. So rather than waiting 90 days for a buyer to pay, exporters can receive early payment against their receivables without taking on new debt and often without needing hard collateral. So the next few slides will walk through two core supply chain finance structures that we work with at Convergence. So number one, receivables finance, where the supplier gets paid early based on an approved invoice, or payables finance, where we're working directly with your overseas buyers and they sponsor the early payment to the supplier through one of our funders. And this normally comes with guarantees on the buyer side or data visibility or simply an approval of invoices. So we'll break down how each of these structures work, who benefits, and ultimately how these can be tailored for Indonesian exporters looking to grow without being held back by cash flow. Okay. So to understand why supply chain finance is such a game changer for exporters, especially MSMEs, what we can do is compare it to the conventional loan model that many of you may be used to. So number one, conventional loans require a formal loan agreement. They show up on your balance sheet as debt and usually depend on your own credit rating and your financial creditworthiness. There's also often collateral in terms of personal guarantees or pledges against property. So this really makes it harder for small firms to qualify. And advance rates are typically lower. So you may have a value of X, but they're only lending you 60 to 80% of the value of that collateral, with approval times being very slow. Now, let's look at this indifferent to receivables finance. So number one, it's structured as a purchase of receivables, not a loan. So this focuses shift to the buyer's creditworthiness, so your overseas customer, not looking at the financials of the Indonesian exporter. The collateral is based on these underlying movable assets, such as invoices, the value of these invoices. Do they normally get paid on time? Do they normally get paid in full? The collateral is not fixed assets. Advance rates are usually much higher, 70 to 90% of the invoice amount. So this really helps suppliers access working capital without adding debt or giving up ownership of your other assets. Finally, there's payables finance. This is often initiated by the buyer or where one of the exporters introduces us to an overseas buyer they have a good relationship with. So in this scenario, the buyer approves the invoice and a funder pays the supplier early. It's treated as a true sale of this receivable, so the supplier gets 100% of the invoice amount minus a discount, which is equal to the financing fee. The credit risk stays 100% with the buyer, and the SME receives early payment also off balance sheet. So again, this is not considered debt. Both supply chain finance structures are faster, they're more flexible, and they're more accessible than traditional loans. And they're particularly powerful when working with international buyers. And the next slides will show how these models actually play out visually and how they apply to exporters such as yourself. So we'll start with receivables finance. This is one of the most common forms of supply chain finance, and it's especially relevant for exporters in Indonesia selling on open account terms. Here's how it works in practice. As you can see on the screen, step one, the seller or the exporter has a commercial agreement with their buyer. As we mentioned, this buyer is normally in a developed country like the US or Europe. After delivering the goods, the seller issues an invoice with the payment terms. But then instead of waiting 60 to 90 days for payment, the seller submits that invoice to a finance provider via the Convergence platform, and there's a pre-approved receivables purchase agreement in place. The finance provider then advances 70 to 90% of the invoice value, usually same day or within 24 hours. When the invoice is due, the buyer pays the full amount directly to the funder, who settles the remainder. So that remaining, let's say 10 or 20%, minus any interest, fees, or discounts. So it's important to note that the buyer is not involved in the financing decision. So this is typically a non-notified or non-recourse transaction. Sorry, a notified non-recourse transaction. The credit risk is based on the buyer's ability to pay, not the exporter. So again, we're looking at the financials of the buyer, the creditworthiness of the buyer, their past historical track record in paying on time, paying in full. We are not going through your financial statements or balance sheet, etc. So for the exporters, ultimately this means no new debt, no collateral, and really full control over when to finance each invoice. This model is especially powerful for businesses looking to manage cash flow during growth or when dealing with long payment terms from overseas buyers. So now we'll look at a related structure, payables finance, where we actually have the buyer involved as well. So it ultimately starts with the buyer in these scenarios. So the buyer places an order and enters in a commercial agreement with the seller. And then once the goods are delivered, the buyer receives the invoice with the payment terms, usually 60, 90, 120 days, whatever the case is. The buyer approves the invoice and gives the payment instruction to the finance provider. So we have two methods for this. Either the buyer provides us with an approved invoice feed, or they can actually approve an invoice that you've loaded to our platform. At that point, the finance provider gives the supplier an option to be paid earlier, typically at a discounted rate. And then the supplier can also choose to take early payment or wait until maturity. And then on the due date, the buyer pays the full amount to the funder. This model is especially useful in large supply chains where buyers also want to extend their payment terms but keep suppliers stable. In cases where a buyer wants to support their suppliers, because there are additional benefits from receivables finance. Number one, you're going to get 100% of the invoice amount paid up front. Number two, with the buyer involvement, normally we can get larger credit limits. We can have direct conversations with them. So let's say one buyer you need a $500,000 credit limit for, but our credit team only came back and said we can only have $250,000. But if we're engaging discussions directly with that buyer, the buyer is sharing their ongoing financials with us. They're actually approving individual invoices and reducing fraud risk. Then we can increase those credit limits accordingly. So this structure is especially attractive in sectors like retail, apparel, electronics, or commodities, where you have large anchor buyers involved and payment terms are long. So we do have also some case studies. So these are two Indonesian garment manufacturers that we have supported. So the first company is a leading apparel exporter with over $700 million in turnover, producing a wide range of garments, supplying top-tier global fashion brands. So despite having several traditional bank lines, they really recognize that in today's market, diversifying liquidity was critical to staying resilient and competitive. Their challenge ultimately was to reduce dependency on their traditional bank lending and always ensure there's enough working capital to handle any production spikes or large orders. So we help them by implementing a tailored receivables finance program, ultimately giving them fast access to capital immediately after shipment. So this gave them the flexibility to scale with the ongoing demand, maintain operational agility, and also they were able to continue investing in ESG initiatives, workforce development, and new market expansion. The second manufacturer, also a well-established exporter with a global buyer base and a strong emphasis on employee welfare and sustainable production. So their primary challenge was not liquidity or bank risk, but rather risk management of their overseas buyers. Many of their large buyers were requesting longer credit terms, which meant delayed payments and greater exposure to buyer insolvency. So if your buyer went bankrupt and they hadn't paid yet, then that obviously causes a lot of issues. To address this, we structured a receivables finance program that included credit insurance. We expanded their facility lines to ensure steady working capital as well, even during periods of demand fluctuation. So this approach allowed them to maintain production continuity, safeguard against late or default payments, and really grow confidently despite market disruptions. Now, again, while these two examples are of large manufacturers, the same solutions work just as well, if not better, for small and mid-sized exporters. In fact, smaller firms often benefit even more from supply chain finance. Number one, because it removes the need for hard collateral. Number two, it unlocks cash from invoices instantly. And three, it helps you accept larger orders without stretching your internal cash flow. And that's one area we've always seen as a barrier to growth, is exporters are often scared to take on new orders because they don't know if they will be able to successfully commit and deliver that order. So whether you're a major player or a growing MSME, these solutions are designed to scale with you. So enabling growth, protecting risk, and also improving access to global trade opportunities. So how to get started? So at this point, we've covered the landscape, the challenges, which you all are quite aware of, and the solutions which we can provide. So let's talk about how to actually get started. Like I said, the good news is you don't have to be a large publicly listed company or have a credit rating to access supply chain finance. Whether you're an MSME or a large exporter, if you're selling to buyers overseas, especially on open account terms, you already have an asset that can be financed, your receivables. So getting started is simple. We typically begin with a short onboarding form and a set of documents, including buyer lists and sample invoices. From there, we assess the opportunity, match it with funders in our network, and we structure a custom facility that meets your working capital needs. So all of this can be done digitally and with minimal disruption to your day-to-day operations. And like I said, we've got a back office team that supports you through every step, from structuring the program to document validation, buyer communication, ongoing reporting. And most of our team that does this is based in Malaysia. I know Bahasa Indonesia, Bahasa Malaysia is not a perfect match, but we have made it work often. So ultimately, if you're an exporter looking to grow without being held back by cash flow, or if you're a platform bank or trade finance service provider looking to partner, we're always looking to help. So I did want to mention, like what I had talked about earlier, all of our financing is automated through our fintech platform, Abacus. So Abacus is this engine that connects everything, bringing together exporters, buyers, and multiple funders into a single digital platform, with three core functions that really make it relevant for Indonesian exporters. Number one, multi-funder connection. So accessing capital from global, regional, or even local funding institutions that we're working on as well. Holistic product coverage. So right now, our focus on Indonesia is receivables and payables, but in other markets, we also have domestic supply chain finance programs. We have pre-export financing, inventory financing, et cetera. So we hope to have those someday soon. And then client-facing simplicity. So it's one process. Even if you're getting capital from multiple investors overseas, you're all working through us on a single digital platform. So whether you're an MSME, like I said, or you're a large exporter managing multiple relationships, this platform, Abacus, is designed to make everything simple, digital, and scalable. So I'll walk you through really next steps. If these are solutions that you would want to look at, what's the workflow and how does this actually take place to make it happen? So step one, you submit a short application form along with some basic supporting documents, typically a buyer list, recent invoices, and some company background. Step two, our team conducts an initial credit and compliance assessment, including a review of your buyers, the trade flow consistency, and documentation practices. So this also helps us match you with the investors in our portfolio and liquidity pool and make sure there's a best fit solution. Step three, we issue a non-binding term sheet for your review. This outlines proposed facility size, advance rate, pricing, any required risk mitigants like credit insurance. Step four, if you're comfortable with the structure, you approve the term sheet. We move into formal onboarding, buyer setup, and transaction activation. So the onboarding will include a KYC process. We'll have to review legal documents of the company, beneficial owners, things of that nature. So the entire process can actually be completed in a matter of a few weeks, depending on your readiness and document availability. And again, this is all managed through a digital platform. So once you're set up, drawing funds becomes fast, it's repeatable, and it's transparent. So I think that's it from our end. I just wanted to thank everyone today. John, I know you were going to quickly recap, and then if we had some Q&A, take that from the group as well, correct?
That's correct, Cliff. Thank you for that. Again, thank you everyone who joined us today. Just to provide a quick recap of today's webinar. First off, we did look at the working capital challenges faced by Indonesian exporters, especially around long-term loan payment terms and limited access to flexible financing. Second, we also explored supply chain finance solutions like receivables and payables finance that can unlock cash flow and reduce risk and support both the large and MSMEs. We also shared real case studies of Indonesian export garments who successfully use the solutions to grow their confidence. And we introduced Abacus, the digital platform that makes all this easy to manage, connecting exporters to a global and regional funders with a single onboarding process. So, if you're an exporter looking to improve cash flow, or a trade advisor, association, or an ecosystem partner looking to support your members, would love to be able to partner and continue this conversation. You can scan the QR code to reach Convergence Capital directly, or you can also feel free to contact Cliff directly using his LinkedIn. You can just scan the QR code seen on your screens right now. Again, thank you, and we look forward to helping more Indonesian exporters grow globally. If nothing from Ronnie and Cliff, maybe we can already start with the Q&A. Okay, so we already received a few questions. If any of the attendees have more questions, feel free to ask on the chat box. Okay. So first question, uh, from Omeko Indotrade. Hello, sir. We are exporter from Indonesia. Does your company also bring us together with buyers in other countries? Seeing your network in various countries, we will also use your financing services. Thank you. Cliff? Cliff, you're on mute.
Sorry, John, can you read that one more time? I
One,
was
okay.
answering somebody's question.
Okay. So again, hello, sir. We are an exporter from Indonesia. Does your company also bring us together with buyers in other countries? Seeing your network in various countries, we will also use your financing services.
Yes, this is something we have done informally in the past. We have made introductions. We've actually got tapped into other platforms as well from a physical supply chain standpoint, where buyers are using sourcing agents and things of that nature. It's not something we've ever built into our digital platform. I think that's where we would prefer to work through a conduit like IEC to help provide that. But yes, absolutely. Especially, I mean, ultimately, what we would need to know is what is your industry, what's your focus. So if you're in garments, are you doing knits, wovens, etc., or if you're doing agriculture, what products? And then we always have buyers and sellers we're working with where we can make friendly introductions in that regard.
Okay, so the next question, I think it's just the same as the first one. How can we find international buyers to start an export business? I think we can just move on to
So
Cliff.
sorry. Well, one thing I would definitely point out there is the American Chamber of Commerce in multiple countries. There's one in Indonesia. It would be good to reach out to them because that is one of the, and other countries have them as well. Sorry, I'm American, so I know how some of these processes work from an American standpoint, and I know there with everything that's going on in America, with the, like I said, the diversification that's happening in China, there are a lot of American companies that are seeking suppliers out in new markets. And one of the key areas they go to is the American Chamber of Commerce within that local country. And they ask them, do you know any suppliers in this X industry that you can introduce me to? So that I think that, and like I said, I wouldn't just focus on the American Chamber of Commerce. Europe and other countries have them as well. Those would be key contacts to reach out to.
Okay. So next question, Cliff. Kevin here would like to has a buyer from Dubai and wants to buy palm oil using SBLC. Can you monetize SBLC?
Our key focus is around open account financing. That being said, that is what we support. We have made references and referrals to other investors or lenders overseas that do support financing of documentary trade transactions. So it could be something we could refer you to, but not something we would directly support. All of the transactions we support are highly digitized, open account trade transactions, and and that will be some cases we often have clients come to us and say, "Hey, can you give me a financing on a UPass LC or USense LC or something of this nature?" Where in the end, we had a discussion with both exporter and an overseas buyer, and they had been working long enough, 2 years plus, where they decided, okay, let's move everything to an open account trade. Let's reduce the bank fees involved with letters of credit. Let's free up the buyer's limits with their own bank and move to this open account finance transaction structure.
Okay. Next question. She from Kiki, a supplier of apologies if I mispronounce the name, from Mitragina Speciosa, aka Kratom. They are seeking for an investment from investor with profit sharing 60% for buyer, 40% for supplier. For the terms, we will stock the goods to our warehouse in the USA. As I have some buyers ready to pick up, there will be a good price. So I need fund to prepare the product. I need to contact you and talk to me more about this.
Yeah, we can talk, but there's going to be limitations from our side because this is more equity type financing. And unfortunately, that's not something we get into. Now, if you have that inventory in the US, again, depending on what type of product it is, depending on who you're selling to, we may be able to provide financing on that inventory or on the receivables to those end buyers. So it's definitely worth having a conversation with Yukiki and see if we can support Kreton.
Okay, so yeah, also there are a few requests of them getting the presentation that we had earlier. Yes, we were going to produce and provide a copy to the attendees of today's webinar. All good. So yeah, next question, Clef, from Imamul Makarim. I see that supply chain finance is good for producers or manufacturers, but what about trader? Can the traders use this program?
I would say it's even more beneficial for traders because traders normally have very little physical assets, right? If you're a garment manufacturer, you've still got your land, your assembly lines, and everything else. Normally, a trader just has people and some desks and a rented office, so it makes it even more difficult for them to get bank lines. But if you have overseas buyers, you're selling to these overseas buyers and getting open account payment terms, then we can help finance those receivables. And we do. Well, let me take a step in. Many of our clients are traders, or however you consider a trader. So we've got commodity traders, we've got garment third-party sourcing agents, all of them where this is a huge asset for them because it's very difficult for them to raise the amount of financing that they need to purchase the goods to then resell. So while we normally don't allow the upfront, let's say pre-export financing or supplier financing for you to go purchase those goods on your side, it does at least help alleviate the back end of your working capital gap when buyers are asking for 60-day plus payment terms.
All good. So a next question, Cliff, from Aaron. Is supply chain finance suitable for new exporters for or new small businesses with very low capital?
Again, definitely. So this is why these are such good solutions, because if you're a business and you've been open a year or barely open a year, you're unbankable pretty much. If you're an SME or an MSME, the banks will not give you any financing. That's different from us. If we see that you have orders from overseas buyers, if you have at least some initial track record, 3 to 6 months plus, of getting those invoices paid, then we can do credit risk on those transactions themselves And we don't, like I said, we don't look at your financials. We don't look at um, ultimately your collateral, land, etc.
All
Sorry,
right.
just to clarify, when I say we don't look at your financials, we often look at financials if you have them just as a measure of due diligence, but we aren't making credit decisions based on your financials.
Okay. So,
All right,
Cliff,
Jeff?
next question is a bit similar, but just if you could clarify again, Cliff. Hello, my name is Gilang. I would like to ask about if we receive buyer payment in terms of an LC, how would your company be suitable for this type of financing? And can you please explain?
Yeah, yeah. Again, like I said earlier, we try and stay away from documentary collections and LCs. We have investors in our portfolio that can finance that, but we don't do that ourselves. We can pass you off. What we traditionally like to do, if you've been working with some of these overseas buyers for some time, move past the LC structure. The LC is a 500-year-old financial product that is extremely outdated. It's often okay when you're starting out a relationship and you don't know the buyer and it's potentially risky, but in today's world where you've got credit insurance and credit insurance that can protect not only against buyer insolvency, but more or less just the contractual obligations of the buyer itself. And we've got the credit databases that we have on our side to see, is this a reputable company? What's their percentage of paying on time to all of their other suppliers? These are the types of things we can help with as well, just from an information standpoint. But yeah, LC's not really a structure we focus on. We can help provide these solutions similar to an LC structure, but with the upfront financing. If you want to work with your buyer and move them off of LCs, they are normally more than happy to do so. But again, if you're using that LC to go to your bank and get packing credit against that LC, then it's not really a workable solution. I would say stick to your LC if you need that packing credit,
Okay.
and the bank is providing it.
Oh, good. So, yeah, next question again from Aaron. Are the buyers strictly provided by CCG Abacus platform, or can we bring our own buyers and then make a deal with Convergence?
Yes, it's the latter half. We don't provide you with buyers. We're not a trading platform. Like I mentioned before, if we understand what you're exporting, your industry, your product, then we could potentially make some soft referrals with buyers that we already work with. But that's not, you don't log your product catalog on our website and then look to match buyers with. That's not what we do. Ultimately, you have existing orders, you have existing buyers. You start logging those invoices into our platform, and then we route them through various credit insurance, financial providers, et cetera, to get you the financing and risk mitigation you need.
Okay. Next question from Ahmad. I am an exporter spices from PT Abi Praya. I want to ask something that what is the relationship between IEC and Convergence, and what is the requirements? What are the requirement details for the collaboration with Convergence? Because I have some existing buyers to expand our business. Thank you.
So with IAC and Ronnie, you can step in as well. I mean, in other markets, also we like in Vietnam and Pakistan, we work with certain associations, especially nonprofits that are working to make make the world better for exporters in whatever country they're operating in. So we actually sought out Ronnie and IEC to form a partnership because ultimately the market education on these types of solutions in Indonesia compared to other markets like that we're operating in like Vietnam and Pakistan, all of them know about these solutions very well. And to be honest, funders are more focused there as well. So Indonesia's had a bit of gap in the market education, which is where we saw the partnership with IEC as a perfect fit. Ronnie, I don't know if you had anything you wanted to add as well.
All good.
Okay.
Ronnie, is there
Yeah.
anything you'd like to add?
Pardon me?
Oh, I just wanted to ask if there's anything that you'd like to add to what Cliff said about the partnership between IEC and Convergence.
Yeah. I already explained to most of our member that we already have a partnership agreement, IAC and CCG. So maybe some member don't know about this. So it's very this is very helpful when you explain directly to our member, Cliff. Thank you.
Thank
Yeah.
you, Ronnie. So yeah, again, as IEC is a partner of Convergence already, you can when if you have any further questions or if you'd like to inquire about our financing programs or just maybe of some advisor questions, you can either contact the information that you're seeing on your screen, or you can also contact IEC or Ronnie directly and inquire to him. Okay. So a next question, Cliff. From Raman, an exporter of coconut derivative. What percentage interest on refunds is given according to the terms and conditions applicable convergence to exporter? My understanding here is like how much is the interest rate and what are the fees? A second question, Cliff. How much is the value of assets committed by the exporter to convergence as a collateral? So I think he's asking what are the collaterals involved, and maybe also if you could add in, Cliff, like how much are the advance rates that we provide?
Yeah. So I'll start with the interest rates and fees. As we mentioned before, our pool of liquidity comes from capital markets providers. So often when we go to exporters, especially some of the larger ones we mentioned earlier, and we talk about our rates, they yell at us and say, "My bank is getting this rate." And I say, "Okay, yes, your bank is giving you a rate that's almost half of what we're doing, but they're not giving you credit insurance on your overseas receivables. They're logging it as debt on your balance sheet, and they also have a pledge over your land where your manufacturing facility is." And so we do that without all of these things. So you are paying for additional flexibility as well. So I like to tell people it's like going to the market and you're going to the vendor and you're complaining about the price of pineapples because of a price of apples, right? You can't compare the two things. So that being said, normally our pricing is I would say on average about 1% per month, but it really varies. It has a big variance because we've done let's say $50,000 limit facilities in the past, and we've done as large as $40 million facilities. So those pricings are going to be very different, and we're going to bring in different liquidity pools and investors behind us for those different types of facilities. Different products will have different pricing. Different credit worthiness of buyers will have different pricing. But yeah, if I had to give you an average number, that 1% per month is probably the best I could do. But it's gonna be based on once we go through that process of looking at your buyers, understanding your industry, understanding the payment terms and how much financing you need, then we can give you a very specific interest rate. The value of assets that need to be committed. So again, we don't take physical collateral. So these assets that are committed are the invoices which are being financed. Now that being said, we expect the full transaction flows from your buyer to start flowing through the bank account through us or the funder in the future. So there have been situations. Let's say you have $100,000 in invoices that you're invoicing to the buyer, but we're only comfortable in financing up to $50,000. So in that case, you're actually pledging 100,000 in invoices to a $50,000 financing limit. So there are one-off cases, but normally you're giving us an invoice and we're giving you 80 to 90% of the value of that invoice as financing.
All right. Before
Okay.
I go to the next question, Ronnie, just want to check if you have access to the chat, right? So you can see the questions.
Yeah, yeah.
Okay. So to the attendees, if any one of you who would like to ask the question in Indonesian Bahasa, you can just type it in Indonesian, and
No
Ronnie
problem.
will help us with the translation. Okay. Good. Now going to the next question, Cliff. What is your from Rani? What is your best payment recommendation for agricultural exporters? As for now, we always face buyers who are only willing to pay when the goods have been received. On the other hand, we need the payment ASAP to run the business. Thank you.
Yeah. Yeah. So we've run into these challenges before as well. So let's say your overseas buyer wants you to pay, let's say, delivery duty paid. Like the goods are actually into their warehouse in the US or in Germany or whatever the case is before they're even going to start that payment term cycle, right? So, I mean, that's very difficult for you because even our solutions, we don't finance until officially title has changed ownership to the buyer. Because remember, we're taking credit risk on your overseas buyer. So there has to be a trigger in your Incoterms to say that buyer now has the title. So what we normally like to have is Incoterms to help you out is selling to buyers on FOB, CIF, or FCA Incoterms where title is being handed over at the port of Jakarta or the port in Kalimantan, wherever you're shipping from, right? Um, so in that scenario, we can start financing as soon as those goods are delivered onto the ship, right? And we can provide that financing. Otherwise, we have to wait until they get all the way to the buyer's warehouse. So again, often you say the buyer has issues. Um, they don't want to pay for something because there's potential issue with quality or dilutions or missed goods or something of that nature. So we actually have partners we work with even on the ground there in Indonesia who can support that. So these are global partners out of one is based out of the Netherlands, out of the EU. They have on the ground staff similar like an SGS where they can do quality inspections at the port, at point of FCA, FOB, et cetera, and give that additional reliance to the buyer and that comfort to the overseas buyer. So that does come with additional fees because you're having to pay for these inspections, but that also helps bring down financing rates because that helps mitigate risk for us and the funder. So it's a bit of a give and take. And that's why there are no specific solutions that fit everyone. We ultimately look at your individual transactions between buyer and seller, and we say, okay, you're doing it this way. We can only finance it in this manner, which is not going to be very beneficial to you, or we can't finance it at all. But we'll always give you an option to say, go back to your buyer, ask if this will work for them. Ask them if they can move to this Incoterm. You will give them this level of comfort from third parties, or we'll do this type of structure with this financing in place, whatever the case is. And then you've at least got another option for your buyers. And in some instances, not only do the buyers agree, but the buyers call us up and say, can you do this for my other suppliers as well? So,
Okay.
all right.
Next question, Cliff. My supply from Imamul Makarim. My supplier is only one cash, and sometimes they are located in quite isolated areas. Do you have a solution for this matter?
And these are, I do not. I'm sorry. I think it's something, if these are domestic suppliers, I'm assuming these are going to be domestic suppliers. Um, I potentially could have a solution for you if we talk later, because there's a lot of things happening in the digital banking market in domestic Indonesia. It's not something that we would support by any means, but overall, like John said, I also do consulting for Asia Development Bank, World Bank. So I'm really at the forefront in multiple markets of fintech businesses that are being rolled out, certain industries, et cetera. So there might be something I could support you with on that, or refer you to. It would not be something we supported.
Okay, we have another question from Aaron. This is a three-part question, Cliff. One is, I'd like to register for supply chain finance. Is there a link I can go to? So just to quickly answer this, Cliff, for you to be able to contact us, you just have to email us on the or send us a chat over LinkedIn. Provide us an overview of who you are, from what company you are, and what is the type of a financing program or what is your financing requirement, and we'll be able to answer you right away. Okay, the second question, Cliff. I want to know more about Convergence Capital's supply chain finance program rules and regulation. I think these are like terms and conditions of how to apply for a receivables finance. A third question, Cliff. May I know what challenges you usually face in the funding of a coffee export business?
Yep. So programs, rules, and regulations. So in essence, if we get through the credit process, we would sign a legal agreement with you, more or less that gives us the opportunity to purchase your invoices or receivables, if you offer them on our technology platform. And that's it. That it governs that piece. It's done in either Singapore or Hong Kong law, depending on the overseas investor. In some cases, it may be in U.S. law. But these are overseas legal regulations, legal structures. And like I said before, it's an asset purchase. We're normally, I don't say not always, but we're normally not financing as like a portfolio of receivables or debt. We can do that, but normally it's all asset purchase. Challenges we face in the coffee export business. We love coffee, to be honest, but it really depends on where and who you're selling to. That's always been our challenge. If you're selling to small traders in obscure countries, or you're selling to distributors in Africa or something of that nature, that's when it's difficult for us. If you're selling to larger known brands in US or Europe, or just larger trading companies in US or Europe, or even Singapore, whatever the case is, we always have to do our due diligence, and we do the due diligence through our credit database on the buyers. And that's what I'd say that the biggest challenge for coffee is. It's always hit or miss. It's 50-50. It's either a name we can finance, or the other 50% of the time it's a name or a country we can't.
Okay, so to answer Muhammad Kiki's question, can we discuss more about after this, Cliff? I think yes, like I said earlier, Muhammad, you can contact us through LinkedIn and through the email that you can see on your screen. Once you've provided us a message or a chat, we'll respond to you, and maybe we can set up a separate call in the future. Okay. So you already answered, Cliff, on the chat, but just for everyone's information, Cliff, it means no hard collateral assets like property rights, just invoice with the buyer and seller.
Yep.
Yes, that's correct from Cliff. Okay. Okay. Now this is a good question from Muhammad Raksam. Is it possible to get a financing from Convergence for an order from a new buyer who haven't had any transaction history with us?
Normally, we treat that in one of two ways. So we would be willing sometimes to start with a completely new buyer if we're financing other buyers that you're working with. And we would not do credit risk mitigation on that new buyer until we had some track history. So that being said, while we may have credit insurance and we would protect against buyer non-payment or insolvency from your existing buyers. For this new buyer, we would not, but we would still potentially finance them. But let's say if they don't pay or they go insolvent and we aren't protecting them, then we would have rights to take from those other orders that we were financing, if that makes sense. Another option is we can get that track and going the payment through a finance structure. So rather than financing 90% of the invoice value, we start very slow and we do 10%, and the next invoice 20%, and then 30, 40, 50 until we get to 90%. But normally, like I said, we normally want at least, let's say, 3 rounds of invoicing with a buyer traditionally. That's always easier. But to answer your question, yes, it is possible. We have done it before.
All right. Um, okay, there's another question. Are there any limits to the countries that can be tolerated, and which countries should be avoided, given that they are well known for their bad credit history by the Convergence Party?
I wouldn't necessarily say bad credit history. I would say mainly it would be due to political risk. So, and this is, yeah, we don't take a look at any country and say they're bad. It's more just if you look at Standard & Poor or Moody's ratings on individual countries, then there are certain sub-investment or not, sorry, non-investment grade countries which we can't take risk on. And I mean, we're talking many Middle Eastern countries, many African countries, Latin American countries, even Asian countries in some regards. But I wouldn't say there's any country that we would say they're just bad credit. Well, other than Italy, always just as a culture, I think pays extremely late. But outside of that, yeah.
Just to add up, Cliff, I think it's also going to be difficult for us to provide financing to buyers that are located in sanctioned countries or countries that are at a war. Okay, all good. Okay, is there any more questions from the attendees? I think that would be it from the chat box. If you'd like to, if you have more further questions, you can just type in here, or you can maybe, can we, if they raise their hand, Cliff, can we give them the stage and ask the questions directly? I think that would be okay. I
Yep.
see Muhammad Kiki is raising his hand. I'll give the floor to you to ask your question, Muhammad.
Hello.
Hello,
Hi,
we hear you,
Kiki.
Muhammad.
Yeah, can you hear
Selamat
me?
malam.
Yeah. Good evening, sir. How you doing? How you guys doing?
Good. Bye.
I see. I see. So yeah, sir. Yeah, I asked a question before. Hold on. Um, yeah, about the yeah, I'm seeking for investment from the investor with profit sharing 60% for investors. Sorry, it was typo, and 40% for the suppliers. And for the terms, yeah, like we will stock the goods to our warehouse in USA there, yeah, because we have a partner in USA to take care of our goods as soon as it has come there, right? And also I also have some buyers ready to pick up there with a good price. So yeah, that's why I also need some kind of a funder to provide me, yeah, for me to be able to buy the product and yeah, and keep the business going. That's it.
Yep.
I really need the investor right now. So I hope with this, with CCG, yeah, they can provide something like funding or yeah, something like that. So
So
what do you think, sir?
yeah, again, our focus is on the supply chain finance side.
Right?
So we could look at your existing overseas receivables book and
Okay.
see if that's something we can finance. So, and if you have other financing lines, so one thing we've looked at, and I don't know if this applies to your situation, we've got clients who, let's say they've got a bank and they've got a bank line, and the
Mm-hmm.
bank has all their collateral, and they're using
Mm-hmm.
that collateral and that bank line to really fulfill the working capital gap because their
Mm-hmm.
buyers aren't paying them in 90 days. So what we do is we come in and we now support that 90 days working capital. So
Mm-hmm.
they still, rather than us replacing the bank, which we're never looking to do that. We're never looking to replace the bank. If a bank is providing a facility, let them provide a facility. The bank is always going to be able to do it cheaper than us. But what we can allow that what to happen is we take on that working capital gap, and then you still have that bank facility from the land that's been pledged to the bank. And then you can use that to reinvest in your business, grow, scale, start new ventures, start new production lines, etc. Now, again, I don't know if you already have bank lines in place or if this applies to you at all. But in essence, that is the specific area we can help is if you have existing receivables from these customers in the U.S., we can take a
Mm-hmm.
look at those and potentially help you with financing that working capital gap, which hopefully frees up your other financing you have in place currently.
I see. That sounds great. Yeah. You know what? Our previous transaction, it was using the LC. Yeah, it was using the letter of credit, and it was valid. And then yeah, for our next transaction, yeah, we tried to use LC, but the bank declined because there was a credit name on it. Yeah, at that time the bank did not allow us to, yeah, to use credit name. So we tried many times using another name, such as breadfruit, yeah, breadfruit, and yeah, many names like green tea. Yeah, the bank knows that it was kratom that we would ship. That's it. So yeah, I think I can just talk to my partners in USA to provide the LC maybe to your company. So yeah, and then ask them to send me the SPA, sales purchase agreement,
Yeah.
as yeah, like a contract or something. Yeah, something like that, sir.
Yeah, before we well, Kiki, let's definitely have a follow up discussion on this, and I
Okay.
think if we get your contact details, John, why don't you keep the contact details up on the screen just so Kiki and whoever else can send us an email if
Okay.
needed.
Sure.
But yeah, I think this is a good potential where ultimately it's like what we talked about earlier. We don't finance LCs, we don't do equity financing, but there's potentially some way to work within your existing structure to go back to your buyer and say, hey, what if we did it like this? And then under that scenario, we could provide financing to you. And it becomes a relationship between the three of us rather than
Mm-hmm.
just that exporter discussion. So, like I said, that's the difference between that receivables finance program and a payables finance program where we have the buyers involved as well.
I see.
But
Okay.
yeah, I think understanding the buyers, the current structure. Let's do that first before we get the buyer involved, and because we can then we can
Mm-hmm.
go with them and say specifically what can or can't be done and what we would need them to do.
Yeah, I can connect you with my partners. Yeah, together. Like maybe we can have something like Zoom meeting like this, or yeah, something like that to discuss more about which way which way to get the deal done or something. Yeah, something like
Yeah.
that.
Fantastic.
Absolutely.
Yep. So yeah, again, if there you'd like to set an appointment with us directly, you can just email us over the or chat us on the contact details you see on the screen, and we can do a follow up a discussion. Okay.
Okay, you have LinkedIn, right?
Yes,
Yep.
it's on this. We have
Okay.
everything on the screen right now.
All right, great, great, great. I'll,
Okay.
I'll yeah, I'll email you soon. Thank you, John
Thank you so
Lester.
much.
Thank you, Sir Cliff. Thank you for the time.
Terima
Thank you.
kasih, Kiki. Thank
Yeah,
you.
my
All right.
pleasure.
Now, going on to the next question, Cliff. Hello, sir. My name is Damar. Our company focuses on spices trading to Europe and Asia. How long processing from submit documents and to approval of financing?
Often, I'll be honest, it normally depends on the supplier. If you have all of the documentation we need, which in some cases is almost, it can almost be as bad as a bank because we have to do KYC as well. So we have to review your corporate documentation, your business certificate, your articles of association. We have to do KYC on beneficial owners and directors. So all of that, ultimately we can do it within 2 days, but it all comes down to gathering that information on the seller side. Um, so yeah, in our best case scenario, we've had facilities up and running in 2 to 3 weeks.
Okay, so just to elaborate on that, what Cliff was talking about is on the onboarding phase. Once you would like to have a partnership with Convergence, like Cliff said, we're going to do a credit assessment and due diligence (KYC). That would normally take about 2 to 3 weeks, depending on the availability of documents. However, if you're asking about the financing processing, once we've already onboarded you to the system, meaning we're already partners, you already have access to Abacus, the financing only takes about 24 to 48 hours upon submission of the financing request. Okay. So what is financing request? Basically, you just have to go to our platform, provide us the documentation, which is the invoice on maybe supporting documents such as the BL, packing list, purchase orders, and then within 24 to 48 hours, we will be providing financing. Okay. All good. I think that would be the last question. If you have any more questions, please let us know. Otherwise, I think we can already also move ahead with the closing. Anyone from the attendees? Okay, we have one. Hello, Mr. Cliff. I am Nasutyon. Thank you for this wonderful webinar. For us, if we want to submit a funding proposal to CCG, do we need to become a member of IEC first? And just for your information, my main product is waste from CPO, commonly known as PAO. Can transaction for this type of product apply for funding from CCG? Cliff? Not exactly very familiar with CPO and PAO though.
True palm oil, palm
Palm oil.
absolutely.
I got you. Okay, okay.
Yeah, yes, we have done palm oil. I don't see any issue with PAO. Ultimately, it depends on what it's being used for, the end product. I mean, if it's soap or something like that, or animal feed, whatever the case is, shouldn't be an issue. I think ultimately it comes down to, normally with PAO, you're going to be selling to other manufacturers, finished good manufacturers, and those are normally in, it could be countries like China or something else. And that's going to lead to some difficulties, like funding a manufacturer in China or funding a manufacturer as a buyer in India. That would be potentially difficult.
Follow-up, Cliff,
Um,
sorry. It's mostly for
gotcha.
biodiesel or SAF.
What is SAF? I'm at a loss on that.
Biodiesel or SAF. Sustainable aviation fuel.
Okay, so both fuels. In those scenarios, yes, we have ESG lenders who that would make very happy. So, but again, it is going to depend on who. I mean, Loka, I don't know if you can ask. Sorry, that's your company name. Maybe. What countries are you selling to? Okay,
Japan and China.
Japan, yes. China, case by case basis, we would have to look at, especially right now in the current market. China is becoming more and more difficult every day.
All right. Any more questions from the attendees? All good? Okay, I think that's it from the attendees for the Q&A. Uh, Good. Uh, okay, just to end to end our webinar today, Ronnie, is there anything you'd like to mention or say to your members?
Okay, thank you, Cliff and John. We are truly excited about tonight webinars, which serves as an important follow-up to the partnership agreement between Indonesian Export Channel and Convergence Capital Group. These collaborations open up new opportunities, but we also understand that many of our members are still becoming familiar with the terms and conditions offered by CCG. And to support you, EAC will be conducting a dedicated outreach to help socialize and explain the TOC or terms and conditions in a more practical, accessible way. So we also want to make communication easier. That's why EAC will set up a special line or dedicated access to both CCG and our team. So you can ask questions and seek guidance and explore opportunities at any time. And we here to support your journey and ensure that this partnership delivers real value to all of us. Thank you.
All right, thank you, Ronnie.
Thank you, everyone.
Thank
Okay,
you.
thank you. Have a good day, everyone.
Thank you. So, John, I will text you later